Good afternoon, guys, and welcome to the podcast. I'm really delighted about today's guest, Paul Moore, and he's an entrepreneur, he's an investor, he's a real estate investor. Most importantly, he is the Warren Buffett type of investor, which he dubs himself as the quote boring investor, but I don't think it's boring, and I think it's a smart way to invest. And he's done a lot of things. He's spoken for White Code, and he's made money, he's lost money, he's come back, he's worked in corporate, and he's been on HGTV, he's written books, and I'm really happy to have him on to add value to the audience. Paul, welcome.
Great to be here, Chris. How are you today?
Yeah, good. I'm really happy to have you and briefly talk about your journey, and we'll dive right into the questions.
Yeah. So I got an engineering degree in the 80s. That was my first big mistake. An MBA after that and went to Ford Motor Company. 5 years later, we started a company and we were incredibly blessed to be able to sell it to a public firm in 5 years. So I was 34, found myself as a full-time investor. So I thought. And I was completely wrong. It turned out after looking back at that, I was a full-time speculator is what I was. And Chris, I didn't know the difference. I should have known. I was an MBA, but I made tons of mistakes, found myself deeply in debt. But thankfully, I started studying Warren Buffett and Charlie Munger and Howard Marks and learned the difference between investing and speculating. And right now my company has 6 funds. We're about to launch our 7th fund, all in commercial real estate. So that's a quick 30-year tour.
Yeah, interesting. And when I started out my career, it was this idea of investment versus speculation. And once I consumed a lot of just from the top experts, I realized what is the difference for people that are starting their journey or doctors that are listening. What were the elements of you speculating versus investing so that people can know the warning signs?
I think the real problem was that I wanted to get the same excitement from my investments that I got from being an entrepreneur. Because like I said, I was in my early mid 30s. And so now I'm looking back 28 years and go, okay, I wanted the thrill of the chase. I was willing to stay in startup mode with minimal knowledge about anything and still throwing 100,000 here, 100,000 there at these things. Got a rush out of the process. I repeated the learning curve over and over. Honestly, at the rate I was going, I could have ended up living in a mansion or working at Walmart. And honestly, I don't think that's a very good way to live. And my wife sure didn't appreciate it either.
Yeah. 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 And there's always this spectrum from talk about what I really love is the Warren Buffett, and I actually subscribe to that as well. And what is, when you talk about you talk about joy of missing out, FOMO and FOMU, talk about these emotions from the investor's perspective.
You asked me about the difference between investing and speculating. I think investing is the difference. Investing is when your principal is generally protected or protectable and you've got a chance to make a return. Speculation is when you principal is completely unprotected and you've got a chance to make a return. And the protection is in the sense of cash flow, having predictable assets that produce predictable cash flow. For me, as a new speculator, thinking I was an investor, I was just obsessed with FOMO. I didn't want to miss anything. And so the fear of missing out caused me to want to invest in everything I could. The problem is Warren Buffett, I didn't know this at the time, said that the best investors say no a lot. The very best investors say no almost all the time. And so I traded FOMO for FOMU, which is the fear of messing up. Charlie Munger, let me back up. Bill Gates and Warren Buffett said Charlie Munger was the smartest investor on the planet. So, Chris, what does the smartest investor on the planet spend his days and nights doing in addition to reading 400 to 500 books a year? Munger was obsessed with messing up. He was obsessed with not repeating other people's and his own mistakes. He stood up before 40,000 devotees at the Berkshire Hathaway annual meeting and said, "We were horses' asses. We failed you, and we don't want to repeat that mistake." He was obsessed with not messing up, and he said, "If you just focus on not messing up, you'll do well." And of course, Chris, I hate to say this on your show because people aren't going to believe it, but if Berkshire Hathaway lost 99% of its value, if it went from 100 to 1, it would still wallop the S&P 500 over the last 60 years.
Yeah.
So obviously Warren and Charlie are worth listening to. And what that gave me over time, as I traded FOMO for FOMO, I got JOMO. What's JOMO? That is the joy of missing out. I just this morning wrote a blog post on an asset that we were the largest investor in, that we had a chance to invest way more in about 3 years ago, and we didn't. And it was a home run, and I wish we had. But I also had the joy of knowing that we did not over concentrate, because that deal could have gone south. And so you get the joy of missing out. It's painful joy. You know what? I did the right thing at the time.
Yeah. A question for you is, okay, the Fed just announced interest rates unchanged. It's March 19th. And what my question for you is, because I talked to a lot of real estate investors, and their number one thing is interest rates. But then you have also the strong dollar, you have tariffs, and then you also have inflation. And how does all of this impact the real estate market, and how should people be thinking about this and positioning themselves?
Great question, Chris. This is another one I hate to say because people aren't going to believe it, but you can go check it out. Warren and Charlie said that in 55, 60 years of investing together, they never had a significant conversation about the economy in their decision-making process. They said they never included the economy in the equation. They were looking for durable asset types, durable assets, great management teams, and they did not care what the economy, what interest rates, all those things were doing, because those were outside their control. And I like to say boring investors know what they can control and know what they can't. Boring investors don't. You live by a crystal ball. In fact, Peter Lynch said those who live by a crystal ball are destined to eat glass. And so we've taken the same attitude at Wellings Capital. We decided we're not going to, go based on the current thought. Okay, RV parks. RVs were incredibly popular from the middle of 2020 all the way through 2023, into 2022 at least. And then interest rates went up, the pandemic passed, RV sales went back to normal, even below normal. We don't care, because we're going to invest in RV parks either way, because we're not looking to the current trends in the economy. We're looking to get incredible deals with intrinsic value built in. And not to ignore your question, but we don't look at that stuff. We generally are looking for durable assets that are going to last, like mobile home parks. They're probably, and multifamily are probably going to be doing well in 1 to 2 to 3 decades, regardless of all those factors.
Interesting. And what is your process for identifying intrinsic value and creating win-win opportunities for investors and tenants?
Another great question. So the answer is, we look for the very best of the best operators who've got years or hopefully even decades of experience extracting or identifying and extracting that intrinsic value. We ourselves, Buffett said, diversification is for people who just don't know what they're doing. And that really ticked me off, because I'm like, hold on, Warren, you're a Fortune 7 company and you're the most diversified company on the Fortune 500. What do you mean? And I realized what he meant was, if Dairy Queen, which Berkshire owns, decided they didn't just want to do ice cream, but they wanted to go back and buy forests to chop down trees, to create pulp, to create paper, to create cardboard, and to do their cartons and their paper bags for Dairy Queen. That's dumb diversification. That's not what he's talking about. He's talking about every individual investor should be diversified, just like a doctor can't be a specialist in 10 things, but a hospital system can have 10 specialists. And that's
Mm,
what Berkshire does really well. That's what we believe in as well. So what we do is we focus on the jockey. We look not for the horse, but we focus on finding the very best operators who know how to find that value, and then we trust them to go and do it. There's more to that story, but that's the primary focus for us. Their secret sauce usually, not always, but usually is acquiring deals from mom and pop operators who don't know or care what they have.
interesting. The other wonderful thing about real estate is the tax advantages, and a lot of, especially the doctors on the show, they understand depreciation and write-offs. But you have tax secrets every real estate investor should know by partnering with the IRS. I was just curious for the audience.
Yeah. I just got a call earlier with somebody who was talking about their 1031 exchange. The 1031 exchange, most people know this, but real estate is the only asset type allowed to do that I know of since the 2017 tax law change. It allows people to kick the can down the road on capital gains. And if they choose to continue that until they die, they call it swap till you drop. And it allows the people who inherit from you to potentially inherit at a higher basis, meaning that capital gain is never paid. And I don't know any or many other asset types where you can do anything like that. There's also depreciation, of course, accelerated depreciation that we got with that same 2017 tax law. Likely, although I could be wrong, would be reinstated now. As we're talking today, they're talking about that. But even if they don't reinstate it, the depreciation allows the cost seg studies. Depreciation allows investors to be getting profits year in and year out, but taking paper losses. And that, of course, that's kicking the can down the road for a future tax, but usually that tax is at a lower rate. There are other things like we invested in a lot of tax efficient deals last year in multifamily. Those could go away down the road, but basically it's where a local entity like the city of Dallas or Houston allows huge property tax breaks in exchange for doing certain things. And those can be massively helpful to the operator and investors to create, number one, a margin of safety, higher debt service coverage ratio, and ultimately higher profits for investors. There's a lot more you can do as well.
Yeah. Especially the city of Houston, I heard its budget deficit of 330 million. So obviously there's a lot of opportunities to partner with the city there. So the next question I have for you is, in this era, we talked about the tariffs and this new political regime. Talk about this area of climate risk, because now a lot of insurers are pulling out of certain areas, certain states, rates are skyrocketing. And so how are you thinking about, or how should investors be thinking about investing when certain areas are more riskier, like California or Texas or Florida, or just hurricanes? And how should they be positioning themselves?
Circling back to the intrinsic value thing, Chris, if an operator gets a deal that has so much potential upside that if the insurance goes up 50%, and we've seen that as more than that, they're still fine. That's the kind of operators we want to partner with. That's the kind of deals we want to do. We recently did an RV park in an area that had, without going into great detail for time's sake, they found all kinds of opportunities. They were running negative net operating income like 6 months a year in the off season because they only had 17 pads out of their 70 or 80 pads open all year long. You know, that they heard that it was going to be $200,000 to be able to winterize and open those other pads all year round. They found a way to do it for $10,000 that the mom and pop never would have dreamed of.
Mhm.
So now, instead of having like negative 5 or 10,000 a month net operating income all winter, half the year,
Yeah.
they were able to get a positive 34,000 a month in the winter months. And that made a massive value change. Basically, they bought the property for 3.6 million, and 2 years later, it's worth at least 5.7 million, which is basically doubling the investor's equity or more at a 50% loan to value ratio. Now, if that insurance doubles for that park, it's not going to be a good thing,
Yeah.
but it won't hurt the potential value, or it won't hurt the potential investment, because they're so far above what they expected already. And that's not even counting raising rates and adding more sites. They're just crushing it. And that's the kind of deals we love.
Yeah. Yeah, and it's really interesting because you're talking about intrinsic values, or every aspect of a deal, the numbers have to work, debt service, how much rent are you taking, your expenses. The next question is, there's this growing concern that real estate is becoming out of reach for average people with a lot of capital or connections can play in driving up equality issues, but you are passionate about driving social impact. So, how does Wellings Capital do that through your impact investing and through your endeavors?
Yeah. So I mentioned the tax abated deals in Texas, and we also have seen those in Maryland, New Jersey, other places where basically it's making affordable housing, keeping housing affordable for a segment of the population. It is unthinkable to me how some people with rents at a slum, 50% of their income, it's hard to imagine how they're making it. So that's one thing we're doing, is we're investing in those deals. That's on the investment side. On the other side, we are passionate about promoting the truth about what's happening in the world. And I'm talking specifically about human trafficking. Chris, if you took the record profits, not the average, the record profits of ExxonMobil, Nike, and Walmart, added those record profits together, triple that number, that's the approximate profitability of human trafficking every year, according to the US State Department, closing on 250 billion a year now. And so we can't solve that problem, as we all know, but like Mother Teresa said, we can solve it for one person at a time. And we're doing everything we can to raise awareness and raise money. We've raised about $840,000 so far, raised, donated, influenced over the last 3.5 or 4 years to fight trafficking and rescue victims. And we recently had a raid that we were part of funding that had rescued 52 little children out of bondage in Cambodia. And we're so excited to see those children get a new lease on life, get a place to live, a safe home, job skills, counseling, food, shelter, etc. And it's really gratifying to be able to do that. That's not why we're in business, but it is a fabulous side benefit of having influence and being in business and having hundreds of investors who listen to us and donate to that. We, if you don't mind me saying, we donate to AIM, AIM. That's the website's aimfree.org. And we're really excited for people to go check it out.
Yeah. And that's the beauty of financial freedom. You can do things that can make an impact and
Right.
help society. It's not just all about accumulating or consumption. It's to help progress and solve big problems such as the ones we were talking about.
Right.
I know we have a few more minutes. And one thing is, where do you see the commercial real estate market? Because a lot of people are working from home, and you walk down New York City or Seattle downtown, and there's just like stores are closing. Forever 21 is filed for bankruptcy. How are you thinking about? Is it done in new areas, or how are you thinking about things?
Yeah, I would have agreed with the people around 2021 who thought office was essentially dead, especially in places like Manhattan. But capitalism's a beautiful thing. And that's just not true at all. In fact, really well acquired office buildings in great locations are doing really well.
Mm.
That just reminds me of another boring investor to listen to, and that is boring investors pick a lane and stay in it. We chose not to be part of office, even though we had a great potential partner in that arena. We've chosen back since 2017 and on to not be part of investing in office. We've chosen a lane and we chose to stay in that lane. Another example is retail. People thought retail was dead. You remember the retail apocalypse and the Amazon effect and all that stuff. New York Times and Wall Street Journal have had articles in the last 2 years saying commercial retail, strip centers, etc., are outperforming most stuff that was gangbusters 5 years ago, like self-storage, which I wrote a book on and I still love.
Yeah.
But commercial retail is going great. So I really think it depends on how much you pay, how you finance it, how you operate it. I know a guy who I met at White Coat Investor a few weeks ago who's succeeding with malls. And I could not have imagined that, but you know, he is. At least he says he is. I love investing in commercial real estate, especially in this country.
Yeah, it's fascinating, and it's just like for everything, there's always a counterexample. To end it out, have something inspiring because you went from rags to riches and back, and you went from you had 1.5 million in the bank, and then you went to 2.5 million in debt, and now you're debt free during the great financial crisis. So, what are some mindsets or inspiring things that you can leave the audience with, and how can they connect with you?
They can connect with us at wellingscapital.com/resources, and they can learn more about this story and all kinds of asset types that we love, like mobile home parks, RV parks, self-storage, multifamily. But what happened is we sold our company in October of 1997, exactly 10 years later. With a partner, I had two and a half, I went from 1.5 million in the bank then, a lot of speculating. I told you that, 2.5 million in debt. And we didn't see any way out of it. Of course, as we all know, America was about to plunge over a cliff in the great financial crisis. Now, you got to remember, we didn't know how bad it was going to get. I'm glad I didn't know, because in December of 2007, as things were getting worse, my CPA's husband, who's a good friend of mine, and also another close friend, met with me at a restaurant, said, "What are you going to do? Are you going to file bankruptcy? What's the next step for you?" I said, "I'm going to give my way out of debt." And they said, "Excuse me?" I said, "We're going to give our way out of debt." I had read these really powerful biographies and historical people who had just really, really believed that karma is true, or other people call it sowing and reaping. That's what I would call it. That's if you give generously, you'll get back generously. And so what I did is I sat my family down, 6 of us, and I said, "Hey, our back's against the wall and we don't know what we're going to do, but we're going to start giving generously to some nonprofits we really care about." This was January 1st, 2008. And then we're going to see what happens. If God bails us out, great. If not, that's okay. And it wouldn't really be okay, but that's face that possibility. Around that time, Chris, my business partner came to me and said, "Hey, bad news. I can't make my half of these interest payments anymore. I'm done. I'm signing all the properties over to you." And I said, "Ted," I said, "we're going to get out of this and we're going to make a profit on these deals. Are you sure you want to do that?" And he said, "Yeah, I'm done. I hope you make a profit. See ya." Ted and I are still good friends, by the way. But at any rate, that started a process where I really was sweating. But we gave generously. We gave the exact same amount every week to nonprofits we cared about. And it was painful. And I'll tell you this, 4 weeks later at a Subway restaurant, I met a real estate developer and I told him my back was against the wall. He gave me an idea that allowed me to convert a non-subdividable property. It was a waterfront property to a dividable waterfront property. It was extremely rare idea. Like it had never been done in this county in 30 years the way I did it. But I did. And 13 months later, there was a lot more blood, sweat, and tears involved. But Chris, 13 months later, in the heart of the great financial crisis around March of 2009, we were completely debt free. We even paid off our house.
Wow. Amazing. Yeah, I really love inspiring stories like that. It's just when you're on the right path and when your back's up against the wall, you're forced to come up with these creative solutions.
Yeah.
I love talking with you, and I know the audience really resonates with your message, especially the doctors and the lawyers and dentists, and keep up the great work.
Chris, it's been a real honor to be here, and I really appreciate what you do. And hopefully, we'll catch up at one of the future White Coat Investor conferences.